All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker WSM Williams-Sonoma. It's kind of been mentioned a few times on the channel. It's been in our watch list for some time. Kind of been waiting to get around to it. Kind of skipped around getting to a few other ones ahead of this one a couple times over, but we did eventually get to it. Looking pretty interesting company. I definitely like the company as a company itself. As a stock, well, it's a little bit more complicated than that, as we've often seen. But before we get into that, kind of taking a look at our watch list, see some movements in the watch list which are pretty interesting. I did have moved my valuation score up and down, which I've talked about in the last stream a little bit. I kind of shifted the weightings of how I'm weighing in certain valuation metrics against each other on all my valuations. So the overall listing has changed in a lot of different ways. But even so, even in the last week, we've seen some changes. Buckle's still at the top, and that's still something I'm buying a decent amount of, which I've talked about on the Discord channel a bit. I've talked about Smith & Wesson's and how much that's been of interest to me lately. That's still pretty up here, but also Turtle Beach is up a little bit higher now. That looks like maybe that could be an interesting thing to buy a little bit more of. I have a decent position in that already, so it kind of depends on other factors like that sometimes, but we'll see in regards to that. But either way, kind of moving on past that. Hey, Avadors, hey, what's up? Welcome to the stream. We have the kind of the other companies that we had screened through our watch list a little bit from various 13Fs in this list, of which WSM was in here, which we're not really going any particular order, just kind of thinking about these tickers. But RGR, I'm pretty interested in maybe doing a valuation of that one pretty soon, just because it'll fit in with some of the other companies that I already have valuations of as more of a little comp group. But then also I've been considering doing Liberty Communications again, because it keeps showing up in many other 13Fs, and I kind of feel like I had some issues with my last valuation of it, so I feel like it could be maybe good to revise it over again. Revisions, we'll get to that as well as morning, but some of these other ones are of interest as well. I'm not sure which one I'm going to do next, but we'll see about that. Also really looking forward to the economic data coming out in the near future. International trade in goods and services came out today. I actually haven't taken a look at it yet, but then we also have the CPI and PPI reports coming soon, as well as the next FOMC 2-day meeting, as well as then import and export prices and retail sales after that, which are also pretty good. Lots of important economic data coming up in the next week or so, but interested in that. So before getting into some other stuff, I would like to ask, if you're watching and you're not already subscribe to the channel, please subscribe to the channel. We're really trying to grow our views, and we've definitely had some strong growth in the last couple months, a little bit lower than some of that, as you can see here in the last little area, but we are growing in subscribers pretty solidly. But the best way to grow is to get more likes and subscriptions. So more likes equal more viewers equals more subscribers. If you're not already subscribed, please subscribe. If you are subscribed, please like. Be very appreciated. And along with that, you can also join the Discord, which we have the link it's pinned in the chat, as well as it's in the description below. You can join the Discord and have conversations with us, various things, portfolios, company analysis, news, and various announcements about all sorts of things. As well as, like I said, I'm announcing my buys that I do each Monday for the week there. So if you join the Discord, you can kind of get that information as I'm kind of doing it. I'm going to start doing it actually Sunday night beforehand, so that people can see what I'm actually planning to buy the night before. But I basically just decided to do that this week, so it's a little bit new with that front. And then last but not least, before we get into actually Williams-Sonoma's valuation specifically, I kind of wanted to go back to the one we did last week, which was HIMX Technologies. I had some issues with it, partially with it's an ADS, and there's an ADS conversion rate of 2 shares per ADS, and I actually kind of had the formula screwing that up in the process here, and a viewer came into the Discord and actually pointed that out to me, so I was able to make that revision. And during the stream, I thought it was very strange that the valuation was coming out to like an extremely negative degree, that stocks can be overvalued, but sometimes when it appears to be so ridiculously overvalued, you kind of wonder if maybe you made a mistake. And it turns out, yeah, in fact, I did make a mistake. So a viewer was able to point that out. This is kind of my revised valuation of it for anybody that wants to take a look at that. I did also change some of the market expectations in the near term versus the short term, which got to this point. But either way, this is kind of a more accurate representation of what I think the valuation for what we did last week should be. So with that, we can kind of actually move on to Williams-Sonoma, the company that we're actually doing today. So with that, we can start at the bottom, kind of doing the typical stuff we normally look at. The company is in a household products kind of business. They do home and homeware pretty much across the board, but they're also pretty majorly an online retailer. So I kind of basically split the difference between those two industrial groupings for how we were going to think about them, which give them an unlevered weighted beta of 1.53 just by essentially averaging the two together. And then sales to capital ratio expectation that gives us about a 2 and a net margin of 12. Since we're being pretty rough with it and just kind of saying half and half house products and half retail online, the sales capital ratio and the net margins are probably not super useful metrics. That's just kind of me coming up with a beta to use for this company because I thought it was very much in line with the household products type business model, but since it's 67% of its business is retail online, we really did have to weigh that factor in. So either way, unlevered beta of 1.53. They have 95% of their business in the United States, about 94% of their assets, so roughly in line with that. So small amount of expansion outside the United States. And with a debt to equity ratio of around 14%, that brings to a levered beta of 1.69. And I come up to a cost of equity of 12.12 for them with that, and a weighted cost of capital of a little over 6% because of their interest rate of 3.2% with a maturity of 7 years. Which is basically just lease liabilities. But either way, it is also set to a maturity beyond the projection point of our valuation, which is always nice. It means that in a certain sense, there's no need to do any new rollover financing per se during the projection period. But of course, they can add more debt regardless of that. So we will take a kind of a quick look at their financial history over the 10 years that I've kind of looked at. You can see that they went from $4 billion in revenues in 2012 to 8.2 billion in 2021. Very, very strong growth in revenues, mostly at this kind of like 5% or so per year on average rate up through 2020 or so. It was picking up a little bit in 2020, but it was also down in 2019, as you can see. About 5.5% per year as a rolling CAGR over those time frame up until 2021. We had a nice little jump there. But interesting to note, you can see that there is actually no year where they had a decline in the revenue. Again, they're with a huge focus, 66 to 67% of their revenue coming from e-commerce. That's partially why they have such strong sustained growth in their revenues, being an overall relatively mature business model, which is to say that they're expanding as the e-commerce grows into the larger share of the overall retail pie, essentially. So very good for them, good business model. They've been able to capture on that growth trend pretty solidly. You can also see the gross margins were basically stable, a little up and down over the time frame, but averaging around 37-38%, and that's kind of basically up and down across this entire time frame, up again until 2021, as I was saying before. So pretty likely to assume that that's not going to be the gross margin moving forward. Probably would come back down to this space that we were seeing here before, which that plays out in our net margin expectations that we have for the company as well. So also taking a look at the net margins that we have for them. They don't have R&D costs, so the correct net margins same as the reported. But up through 2019. We have an average of about 6% for a margin. Generally, it's pretty stable in that range, as you can kind of see, a little bit above, maybe about to 6.5%, but then down to maybe just shy of 5%. And then we have 10% in 2020, and then 13 to 14% in 2021. So yeah, probably unreasonable to assume that these margins are going to be where we're going to be in more of a terminal period. And so rest assured, we're definitely not going to be making that kind of assumption. The average for the 5 years prior to that large spurt was 5.81. And then the average 5 years, including those years, was 8.1. You can kind of like maybe split the difference between the two. You get to maybe like 7% or something like that. Also just maybe taking a longer term average, including those years, you get still some maybe around 7%. So 7% maybe being kind of a more realistic midpoint if they were to maybe be able to successfully capture some of that margin in the longer term. But definitely it's just a question of whether or not that's actually sustainable because of their transformation into e-commerce, because e-commerce typically does have higher margins, but also their business model is not the type of business model where you typically get higher margins per se. Relatively higher quality home furnishings, depending on which company sections we get into, which we'll take a look at their earnings deck and we get into some of that information. But taking a look at their cash flows, we can see that over the last 3 years, they've had about an average of 451 million free cash flow to equity, which is cash flow that's available to pay out to their shareholders after paying down their debt. And then the amount that they actually have paid down to their shareholders, including buybacks, has been 565 million on average during that time frame. So a little bit of an overpaid in the last 3 years. However, if you look at the 5-year average, it actually comes in clean. 421 is what they earned, and 492. It's a little bit safer in that regard. And then 10 years, it actually comes even closer. 336 million is the average, and then over the time frame 404. But over the entire time frame, you can see it still shows that they're paying out more cash to their shareholders than they're bringing in free cash flow to equity. Now, generally speaking, that's something that I think of as a negative, but there you can kind of double check a few other things to see whether or not that's actually a big deal, which is in the cash and equivalents, for example. You can see have grown over the entire frame. They've gone from kind of 400 or less as an average in the first 5-year period up to now they have 850 million on their balance sheet. They had 1.2 billion prior to that. Average over the last 5 years, 642. So by any metric, you can say that they've been building up cash in their balance sheet, regardless of the fact that they've been paying out the buybacks. And you would say, well, maybe they're building up their liabilities. They certainly are building up their liabilities, going from about maybe $1 billion as an average over the 3 years prior to something close to more like 3 billion in liabilities as an average for the last 3 years. But if you compare that to their assets have doubled. Now, it's definitely true that their liabilities are growing faster than the assets are growing. However, they're still managing to also grow their retained earnings and their shareholders' equity. So I would look at this as actually just a really well managed amount of leverage, and the amount of money that they're paying their shareholders is not actually a problem, because all the ways in which that would be showing itself up as an actual problem are not there. They have cash, the cash is building up, their retained earnings are growing, their equity is growing, and yes, their liabilities are growing faster than their assets, but again, every other aspect of the balance sheet is still working out pretty well. So no problems there. Hey, what's up, man? Welcome to the stream. Man, you really going hard for the GRPN. I still haven't really taken a super solid look at it, but as we kind of said in the server, it's definitely not something that super interested in. Maybe we'll take a look at it on Yahoo near the end of the stream. Remind me when I finish up with the summary, and we'll go through it. But we'll see whether or not we go any further than that. So anyway, kind of taking a look at where the cash flow goes with returns on invested capital. However, you can see very strong returns on invested capital. For the first 5 years in the historic section, we have 25% as an average, pretty solid. And in the more recent 5-year period, we have closer to 30% as an average, definitely having these 50s and 30% being heavily in the weighting there. Maybe we'll see about it. Avador thinks maybe if I give one person a look, maybe we'll get another one. I see you hopped over to the YouTube chat. Interesting. I'm not sure if you ever joined us in YouTube before, always sticking in Twitch, but hey, cool. Anyway, moving on. So I kind of basically already covered the balance sheet as far as how it related to paying out the cash flow to shareholders, and there isn't necessarily too much more to say as far as that goes, other than you can see that they definitely are building up their inventories pretty solidly, which is a little bit of a warning sign. I mean, there's been problems with inventories in 2020, but now the real concern is whether or not people are building up their inventories too much, and how much that's going to hurt their profit margins moving forward. So I definitely would be somewhat concerned about that a little bit, but that's not necessarily a problem if they can keep boosting those things. Oh, very nice, Israel. Nice to hear that. Always interesting. Were you the person that was suggesting INMD to me? We were trying to figure out which person it was, because I get so many recommendations from so many people, and at some point when I was doing it, talking about it, I remember people were like, "Where did you find out about this company from?" And we couldn't remember where it was. Oh, okay, maybe not. But I thought maybe so. It's a Israeli company, so I thought perhaps maybe it was maybe we have somebody else, or people just are interested in the biotech industry in Israel, which is fair. Regardless. So okay, I'll also take a look at the sales capital ratio before I move on. So sales capital ratio over the kind of time frame, you can see very strong sales capital ratio, very much like we typically see in a more service-based business or a retail-based business. Those typically you see lots of high sales capital ratios and typically just lower margins. Oh, it was you? Oh man, so I can't freaking ever remember who recommends what. You have to forgive me. Not to mention, people also have different names depending on which platform we're on, so sometimes it's also hard to keep track of which person is which depending on the platform as well. But word. My bad. Anyway, so yeah, sales to capital ratio pretty strong, around 4 is as kind of an average in the first 5 years, and it's kind of dipped down a little bit in 2019 and 2020 as they kind of made some larger capital investments, but it's all, as you can see, kind of pushing back up towards 4 in the more recent year period, and I definitely believe that we can kind of assume that it would stay that way in the longer term period moving forward. It's fine. One with PATK, IMDb, Zim, all the good ones. Oh yeah, of course. But so anyway, we'll take a look at their earnings deck. Also, before actually taking a look at the earnings deck, they also had news with their more recent first quarter earnings that they increased their dividend and also had a 1.5 billion stock repurchase authorization. So that's always worth noting. People like to be aware of that 1.5 billion against the 9.3 billion market cap they have here. We just assume maybe that they use that over like 3 or 4 year period. Then you definitely got like, you know, a nice solid several percentage points per year coming down, which they have a solid history of. I didn't cover that part in the kind of the historic data, but from 2012, they went from 98 million shares outstanding to now about 74 million if you include the RSUs as well. So they've done a pretty good job of bringing down the shares consistently, 2-3 percentage point CAGR per year. And they have an authorization to essentially keep doing that over another 5 years if they spread it out. So we'll kind of actually go through the earnings deck a little bit more than I do for a lot of other companies, because I actually found that they actually provided some really useful financial information, enough so that I wasn't going to have to build like a revenue model myself for the company. I was just like, you know what, honestly, the information they provide in their presentation, I think, gives me a baseline for where I can say, or I think their best case and worst case scenarios come from. I don't know if I ever say, but Halazim it's good too. Yeah, I don't think you've mentioned that one, or at least I definitely don't remember anybody ever mentioning that one before, but maybe we'll take a look at it at some point. So anyway, taking a look at WSM, they're pretty split by the different sections of their brands, which we'll kind of take a little larger spread of them. And for people who are not aware, they're owners of the Pottery Barn brand, which the combined Pottery Barn and Pottery Barn Kids makes up more than 50% of their revenues, and then West Elm, a little bit of a lower end but more modern style kind of homeware business, making up a large section of their revenues, and then their actual name brand Williams-Sonoma making up another section of their business. So a huge section of their business coming from the Pottery Barn specific brand, but definitely a large dispersion of different brands in different price points in different market spaces. Like they have a lot of information on the addressable markets that they're trying to hit, which is exactly what I said I'm going to basically rely on when making my revenue assumptions. Here showing basically their TAMs they like to look at it. The 8.2 billion that they currently have being the small slice, 300 billion US home category, obviously a very wide category. So what section of that they can necessarily get is pretty select. And then US B2B, 80 billion, they do a lot of B2B sales. So that they're arguing they can pick up a large section of that as well, not to mention the global home category, another 450 billion. Obviously, companies love to like make the largest market opportunity that they can possibly throw into these slides as possible. So there's like no way they're really going to get that much of this share. 830 billion is a lot. As I said right here, we operate in a highly fractured market where no one owns more than 5%. It's like, yeah, no shit on that one. So what I did do was basically say, well, let's just ignore the global section of it. Yes, they have 5% of their revenues already in international markets, but I'm just going to kind of not really think about that. We'll think about that as kind of like icing on the cake. Let's just kind of think about the US B2B and US home category, 380 billion. You assume that they get 5% of that, which is what they say. It's like no one owns more than 5%. That turns out to be 19 billion or so. And no one says they own more than 5%, but you can call whatever amount we're making up the slack of that as their global section. So I think 19 billion is a pretty reasonable number to just kind of roll with as a pretty solid best case basis for the next 5 years, because it's 5% of their proposed TAM, but we're kind of selecting it down into, I think, a more realistic section of it. I'm basically saying half of this is, I think, more realistic than what they're saying here. So that's basically what I am going to be using for my revenue assumptions. You can see I have it essentially laid in to get to 18.6 billion in the 5 year forward period. That it's a little bit lower than that, partially because I like using even percentages here, but also has to do with the fact that I have the base year set to the average of the last 2 years, so that we can kind of get a decline in revenue in the current year downward, partially because of my assumptions that the market is going to have a little bit of a slowdown this year. I've done that in a lot of my more recent valuations, essentially assuming that people are going to have revenue hits this year and margin hits this year, and then it's going to move up into their projected numbers moving forward. So we will kind of take a look a little bit more of the earnings spread before I actually move forward into the rest of the projections. I just kind of wanted to show that that's where we're going to put the information on the revenue projections moving forward. But they also had some other slides I kind of wanted to take a look at, showing, for example, here the different brands that they had by the revenue sections that we were talking about earlier, kind of showcased by price point, as well as a certain aesthetic classing that they have from modern to classic. So showing how they have some cheaper brands right here. As I was saying before, the Pottery Barn Kids, it makes up about 50% of their revenue. So this is kind of really where a large amount of their price point lies, is here in this space. But then the next largest section of the revenue came from West Elm, so that comes down into the lower price point, which I think is a pretty good way to diversify downward. And then the next largest was Williams-Sonoma, so then kind of coming back up into this price point right here. So then the rest kind of filling in the gaps there. So a pretty good amount of diversification across price points, though a definite weighting more towards a little bit of a higher price point, which can insulate you in certain ways from certain market contractions, admittedly. So that could help with those assumptions moving forward. Lots of good collaborations with good strong brands and other producers of varying kinds and labels of different kinds, Lego, Marvel, Star Wars, various other ones. Always good stuff for that, and especially in the lower price point, good stuff for that. And then, as we said before, about 66% of their business coming from e-commerce, so a huge amount of business coming from e-commerce, which could help bolster the idea that even if there is a little bit of a slacking in the overall economy, maybe the e-commerce continues to grow as an overall share of the pie, and therefore providing an opportunity for them to even be relatively flat for the next year or so. And then further down here, they also had a very specific revenue bridging towards as they're calling it, path to $10 billion in revenues, which is another thing I'm using in my revenue assumptions, kind of placing myself relative to what their assumptions are right here, which includes them kind of taking on small sections of that pie of the TAM that we were looking at above right here. They're assuming they can grow a certain amount in their core business, a certain amount in B2B, a certain amount in the global and the marketplace across from the fiscal 2021 towards their 2024 target of $10 billion in revenues, showing it kind of disaggregated by the different brands as well. So I thought this was very, very useful, but it is international. Yeah, it is international, but it's 5% of their business is international. So it's just, it's a relatively small slice of the pie so far. If they could get a relatively larger section moving forward, but since it's only 5% of the revenues, I'm basically just growing my assumptions based off of the current proportion of things as they are in the United States. Because even if they grow that, no, I meant the suggestion I made, but it is international. What do you mean? I'm not sure. Maybe I missed an earlier comment that you made, but I'm not sure. Anyway, so kind of showing, as I was saying in here, if you take a look at, if you assume that we don't rebase the revenues to kind of a lower number with the assumption that there's going to be a slowdown in this year, as I was saying, and instead just have it be as it would normally would and have the revenues grow as is, then 2024, which is this line right here, if we look at kind of the average across all the different models, we hit 10.2 billion. So this essentially assumes that their model fits in place. And so by essentially shifting the revenues downward to have a little bit of a slowdown in the first year and then build back up thereafter, I'm essentially assuming that they are slowed down about 1 year from their plan. So they believe they can reach 10 billion by 2024, essentially with a little bit more of a conservative estimate. I'm assuming that they hit it in 2025. And then we also make a few other more conservative assumptions, but we can get into some of that stuff as well. That's basically everything I kind of want to look at in the earnings deck. But as I was saying, we're also doing a little bit of rebasing to the revenues rather than assuming that they're going to go from 13.6 smoothly down to our kind of expected revenues, which, as you can see right here, is about 7 to 8%. As we had said before, the kind of longer term average we were seeing for the revenues was about 7% if you included the most recent years. So I'm assuming that they could go back down most of the way towards that, but then maybe they get to keep about 1% of it as part of their e-commerce expansion. So maybe around 8% is what I'm saying. But however, we're not assuming that they kind of smoothly jump down to it. We're also assuming that on a basing of the last 3 year average of around 9 to 10%. So we're assuming that in the next year, it'll be closer to 9% as they move down towards that 8% margin over the 5 year period. So we get those two combined rebasing effects have a pretty significant effect on their value. As you can see, it does show that they're basically fair value according to all the assumptions that I put in here. If we do shift
both of those up, basically assuming that they're not hit by any sort of economic slowdown whatsoever. We just assume that everything goes according to plan and they keep growing accordingly with that. But we're still assuming that they have their margins come back down to where I think they should be in the long run. However, they do it a little bit more smoothly. They get more profits over the next 2 years. You put both of those assumptions back in, and then suddenly there's a decent amount of upside on the expected value basis. So that is worth noting that what you think about the short term does actually have a decent effect on their value, even though the long-term assumptions can remain the same. The profit assumptions for the next few years can be a little bit different. Though admittedly, we would actually have to make maybe a little bit more of an assumption further than that, because we'd also have to bring this down a little bit since the rebasing effect isn't there. This has to go back down to about 19 or so. Yeah, so about that, but still higher either way. So you kind of have to shift more than 2 assumptions. You have to shift 3 to kind of keep them consistent with each other. But either way, so those are the assumptions I'm leaving in, the rebasing out of the 3-year average, and then basing the revenues around the 2-year average, having it move upward towards a highest range of 18.6, just under the 19 billion that we were talking about. And then as far as the lower range, I'm kind of assuming that it's essentially flat over the time frame. That's the worst case scenario I assume for them, is that their revenues would be flat. And the midpoint, it comes out to being roughly about 50% increase in revenues, which is kind of what they did over the last 5 years. So it's not necessarily an atypical assumption. It's a little bit faster than they did in the 5 years preceding that. So it's a little bit of a strong assumption for them on that. So, we are giving them a relatively rosy revenue growth assumptions. It's really just the margin, I think, where we're being particularly conservative one way or the other, just because I definitely don't think they can sustain 13, 10, or even 12% margins going forward. Maybe they could stick around 10% or something. I don't know. It's hard to say where that could necessarily end up, but I'm definitely assuming that it goes back down closer to the, like I said, this 8% point. And I'd just rather that they were more, I'd rather assume they were be more optimistic on them on the revenue side, not the margin side, my bad. Slip of the tongue. Anyway, then with the sales of capital assumptions, I'm assuming a worst case scenario that they drop down to around 2. They're roughly around 4 currently, and they've had around 4 over the longer time frame. So assuming it gets cut in half is pretty typical of the worst case assumptions that I typically have for a company. With the higher case assumption, really not necessarily too much higher than where they currently are. I don't really think that they could push it too much higher than that. And over the longer term average, they've never really gone too much higher than 4 in the first place. So I think that that's a pretty strong upper bound based off of their historical history, which gives them a mid case of around 3.2 and an expected ratio after moving down through the rest of the valuation of around 4, which makes sense. At like 3.2, I think is a pretty conservative mid case, and then the expected value comes out close to where they currently are, with the assumption that maybe they actually even improve their sales capital ratio moving forward, perhaps just through share buybacks alone by shrinking their capital base. That could be it. So that's always a factor. So with that, that's pretty much all of the assumptions that we have to put into the company to get our valuation. Pretty much everything's in place. I did already adjust for the default probabilities before starting the stream, and we didn't actually shift any of the assumptions from where they were actually had them prior to starting the stream either, so don't actually have to adjust that to move forward. One last thing I will point out, though, however, I did actually talked about the returns on invested capital, but I didn't actually show them compared to our projected ones. We have 27 to 28% if we look at over the last 9 years as kind of an average, which includes all of the more positive returns on invested capital more recently, and then the lower ones of some of the years. Comparing that to the assumptions that we put into the company, we can get an expected returns on invested capital out the other end of 32 to 33%. So we would be assuming that they would be improving their returns on invested capital a little bit from where they currently are with this valuation, which makes them roughly fair value. So, like I said, this seems like the market either is assuming a different set of assumptions than I am and coming up to kind of a similar number, or they have kind of a similar set of assumptions in place, but I'm getting it that it's 1% or so overvalued, and that's apparently what the market seems to think one way or the other. So it looks like I agree with the market in this one. So with that, we can kind of take a look at the overall summary. U.S. Treasury selling just under 3% today. Equity risk premium that I currently have is 5.34%. Discount rate for WSM, I come up with just over 12%. They currently have a dividend yield of just over 2%. As we talked about, they do have a share buyback plan in place. 5 years ago, they had sales of just over 5 billion. And in the most recent year, we had 8.2 billion, which gives them a sales growth of about 10% per year on a compounded basis. Sales to capital ratio 3.23 has been the average for the last several years, compared to the industrial group that we came up with them of just over 2. That, like I said, I do think the industrial grouping to be a relatively weak comparison for this, because we were kind of choosing that industrial grouping more to narrow in on the type of beta risk that we wanted for them more than the margin. Sometimes we have to pick which one of those we want to be effective, and usually we choose to make the beta more effective than the these things, because this is just kind of a comparative thing. So we don't really need to think too much about that, but whatever, I digress. Returns on invested capital, we haven't, as I said just recently, over the last 9 years was about 27-28%. Debt to equity ratio currently is about 13-14%, and in the most recent year they had a little over or 1% of default risk relative to the debt pile that they have. Profit margins over the last several years has been 9-10% on average, and we have profit in the most recent year of 1.1 billion or so. They're currently selling for 125.73, and our probability distribution, which I actually didn't mention before when I was looking at the revenue, I do have it relatively tilted towards the more optimistic end of things. I am essentially assuming that they'll probably, like I said, I do think they'll have a dip in the revenues in the next year or two, like I am with most of my valuations, but I do think their growth path is strong. I think they have a really well placed and diversified set of products in different markets, even though it's mostly the same industry. They managed to hit lots of different markets, and I think that helps with them. And their e-commerce focused business, I think, is very strong as well. So I am relatively bullish on the model. So I did lean relatively into the more optimistic sets of the model. So that is worth noting. But based off that, I have revenue assumptions, the worst case scenario of $8.3 billion 5 years from now, against a best case assumption of 18.7 billion. On expected basis, I see 13.5 billion, which is sales growth of roughly flat in the worst case scenario to possibly 17-18% per year in the best case scenario. On expected basis, we see about 10%. LY, no, never done that one. Sales to capital ratio on expected basis, we're assuming 4.2. So pretty strong sales capital and overall sales assumptions. Those are definitely the more bullish parts of our valuation here. Returns on invested capital, we have pretty strong expectations as well, around 32-33%. And debt to equity ratio, I do assume that they'll likely increase this a little bit, just maybe taking on a little bit more debt, or perhaps their market cap staying laggard for a year or two as that catches up in pace with it. One way or the other, I do think it'll maybe be a little bit higher 5 years from now. A slightly conservative assumption, but either way, I come up with basically no major default risk with that debt, so that's good. We do have a profit margin distribution of anywhere from 3% to 11%, with an expected amount of 7.8% or so. So that's essentially where we are, being a little bit more conservative, assuming that they're going to come back down most of the way towards the longer term average of their margins, maintaining maybe about 1 percentage point of the excess that they've had over the last several years, which gives us a profit distribution of anywhere from 249 million in the worst case scenario to possibly just over 2 billion in the best case scenario, about 1 billion or so as an expected basis. So we end up with a present value price using the discount rate that I came up with of $123.92, which is 1.44% lower than the current share price. So a little bit overvalued, but pretty much just fair value. 5-year forward value targets, unadjusted for the dividends that they pay out during the period, of anywhere from $88.61 to possibly $409.62. On an expected basis, we see $219.56, which compared to the current share price implies a return with that discount rate as well of 11.79% per year for the next 5 years. So, you know, I mean, on an absolute basis, that's a pretty good return expectation. It's just not appropriately risk adjusted according to the risk of the category that we assigned them to. So yeah, nothing special here. I mean, the business is pretty excellent, but as far as investment opportunities, definitely nothing special here. It's like, I definitely think it's a super great business. I really liked the way that they present themselves in their earnings deck. Like I said, it's like all the information I needed was basically there. Very, very investor focused kind of business model. Very, very high quality balance sheet and returns. And I like their overall growth path, but not at these price points. I think LY is a good short. Oh, interesting. Okay, so with that, we did, you know, finish the valuation. We'll go take a look at those couple of guys we're talking about. We'll take a look at GRPN, ELVT, and then, I mean, I guess we'll take a look at LLY. Why not? Oh, and Halazim. Let's kind of take a brief look at some of those. Pull up the Yahoo
which, I mean, I guess I didn't actually go to it when I was doing the numbers, but I mean, I can show that here too on WSM. The analysts are relatively bullish. You can see 23 analysts for 2023, 2024. 5% is what they're assuming this year for sales growth. 2.7 is what they're assuming next year. So definitely a slowdown relative to the growth that they've had in the last few years, but they're not assuming like a drop in revenues like I'm essentially implying. Although it's worth noting that I'm not necessarily implying a drop in revenues per se, because of the fact that I'm also assuming that they're going to grow at a fast clip thereafter. It's just the basing comes down. So technically it's like on an expected basis, I'm still assuming that they grow about like 2% this year before adjusting for the actual probability. So it's actually more like 3% or something in this year. So in a certain sense, I'm more negative than the analysts, but not really. The analysts are assuming about 5% sales growth, and I'm assuming 2 to 3% sales growth, sort of. You know, like I said, it's like I'm assuming a slowdown with that basing effect. It's not necessarily a drop per se. It's just most of the other valuations we did, it equaled it actually a drop because the growth thereafter wasn't that strong. Are you only investing in the US, or are you also investing internationally? I am investing internationally. I am currently a shareholder of Alibaba, and I have invested in plenty of other foreign companies as well. I'm also a shareholder of Barrick Gold, but that's Canada. That's like Diet America, isn't it? So, kidding. I'm kidding to all my Canadian viewers if they're out there. I love you. Anyway, so let's take a look at the other ones. INMD is Israeli. Yeah, it is. And obviously I had no qualms about valuing it, but I also would have had no qualms about investing into it. I'm totally fine with investing internationally. I might limit the size of positions a little bit for internationally. I might consider them extra risky and stuff like that. You know, I'm going to take those things into account. But I'm not afraid to invest internationally. In fact, I think it's dangerous to invest only in one market. If you're gonna invest only in one market, the US is the market to do it in, I guess, because it's the biggest, but that's part of the danger. So, you know, yeah, I think global diversification is good, but you can also get the global diversification partially just by the revenues that the companies have. But having the incorporation diversification is also, I think, a real thing. So anyway, looking at Groupon. Taking a look at Groupon, they're going to drop their revenues apparently as expected this year, according to 6 analysts anyway, with growth of 9 to 10% thereafter. Interesting. Let's take a look at their holders. 37% insider, 67% institution. Thanks for joining the Discord. Love it. Catch you next time. All right, 16% shorted. Yes, please like the vid. I like that we already got 3. Maybe we can get a couple more in. Thanks for always pushing that new kit. I see that. Going to financials. What market cap is Groupon at? $500 million or so. Wow. So there's really low price of sales, 690. See, this is the net income. The drop in revenues would have been against this number. It's one thing you always kind of want to keep in mind when you're looking at Yahoo Finance, and this is true of lots of other places, but in case you're not necessarily aware, it's like, keep in mind, like when you're looking at the revenue growth, if you're thinking like right here, it says current year 2022, we're a negative 28% in revenue growth. You got to keep in mind that what they're assuming is the 2022 revenues. So that's not going to be 28% drop from this number, because this is the number that includes the first quarter, right? It's going to be 22% drop from this number. So always make sure you're selecting the right number on here. Sometimes it's easy to look at this trailing 12-month number and because you think it's the most recent, and so you're like, oh, well, this is the number I need to look at. It's like, well, if you're going to look at the analysis page that they give you on here, they're giving you fiscal year by fiscal year, and that's the only way they give it to you. So make sure that you apply it to the right thing. So it is worth noting that when it says that they're going to drop 29% of their revenues, they're dropping 29% of the revenues against this, which would be like
300 million or so. So not 28% drop against this. AREC ran $2 to $15 past 3 days following FDA approval of their air purification device. Also, warrant exercise price was at $12.50. Dang. NASCAR all out. You look new to the chat. Welcome. Please subscribe and like if you haven't already. Interesting how it's trading right near that $12.50 price. Well, that would make sense if there's a very strong amount of warrant pressure there. You know, if everybody knows that if something can exercise there, it kind of acts as a strong bottom against things. So definitely the type of thing that you can see in something. Let's take a look at the balance sheet for Groupon. Take a look at, like I said, they're a little bit of a basket case business model. The question is, how much of a runway do they have to work with? Not a lot of cash and equivalents, but not terrible against, I guess, their size. I mean, if you look at their market cap, it's more, they have more cash on them than the market cap, but how does that compare to the rest of their debt? Let's see, total debt 414 plus the equity 600 minus cash 200 against, what was their revenues? 800. So okay, very strong sales capital ratio. Not amazing margins, but it's at least real now compared to where they were in the past. What's their cash flow statement look like? You know, the operating cash flows aren't really that much better than that. Wait, come back to the total debt. How much cash was it? It was like 450. 498. Okay. Interesting. I wish they would just pay down the debt, I guess. I don't know. At least they have the cash on hand to do so, but well, I mean, you know, it's interesting. Like I said, it's interesting that they're at least in a position where they're not necessarily going to if they can maintain the margin where they're currently at, because like I said, if they're still net income positive in this quarter after taking the hit this much, which isn't really like all the way, because we're saying that they might get down to 600 million by year end. So if they drop another 250 million, they just dropped 250 million in revenue, they're going to be at a loss by year end unless they make other cuts to their COGS or their other expenses. So that's a question about that. I could talk for hours about sympathy plays after a big move like our last big sympathy play coming around. Recent photo. Hey man, join the Discord and share that information there. Some of our other viewers who aren't necessarily watching right now love talking about all sorts of deals, approvals, mergers, acquisitions, things like that. We love talking about some of that stuff. Join the Discord. But yeah. So anyway, GRPM, bro, that's pure speculation. Don't gamble too much. It depends on the way it's framed. There's depends on the deal that's being done. I mean, if there's a value investment underlying something, sometimes it can be good. LLY, we're headed there. We're going. Or actually, wait. There was the other one we were supposed to do first. What was that other one? GRPN. What came after that? ELVT. That was it. We'll take it LLVY next. Elevate credit. Yeah, LOY was the short interest one. Elevate credit. Online credit solutions to non-prime consumers in the United States. Company offers unsecured online installment loans, lines of credit, credit cards. Interesting. 25% expected revenue growth this year, 23% the year after that. Only 2 analysts this year, 1 analyst next year. So not very much strength in those assumptions. 20% insiders, 40% institutional. Statistics, 2% shorted, nothing too major there. Interesting. What was the market cap? 85 million. Woo! A little baby. Let's take a look at this. Operating expenses. It depends on what you mean by speculative. See,
That's the question. I mean, you can. I mean, I assume that they might be being critical of anything that's not necessarily a value investment, but I would argue that certain types of things that people might consider speculative can be framed as a value investment under certain circumstances. Granted, the majority of certain things and certain strategies might be very speculative, but that doesn't necessarily mean every example is. For example, I'm pretty into like the merger arbitrage space, which isn't real arbitrage, but that is the term for it either way. And I think that you can definitely enter into operating those types of strategies in ways that still count as a well-managed value approach, depending on how you do it and which companies you would get yourself involved in. But there's definitely lots of ways that the same thing can be framed as speculation. So it all depends on the context of the situation. Different people want different strategies, and part of the reason that the returns are as good as they are for different strategies is that other people don't want to take on the risks that are inherent with those things. Risk and reward is correlated for that reason. Accordingly, it's like people don't want to take on the risk, and that means the price drops to a point where the reward is large enough that people are willing to take on the risk. So it's like that's just how the market functions. So anyway, Elevate Credit, still looking at this. Obviously, it's not profitable, so that's always not super great. I do like that they have the huge growth assumptions ahead of them, which definitely helps with that. And flipping over to the cash flow, however, and suddenly the profitability looks a lot better. You can see the operating cash flow is very positive for all the years that they list here, regardless of the not so great profitability that they had before. Investing, significant investments definitely being made there, so financing is having to be done. Are they issuing shares, or is it net issuance of debt? Okay, well, that's always nice. Take a look at their balance sheet. Click Digital is also interesting. Cash and equivalents, 85 million or so. Okay, so pretty decent amount of debt. That's the issue, I would say here. Granted, they are a credit institution, so that's part of the thing that one would kind of assume with that. All these are penny guys. Well, I mean, this one is, and maybe some of the other ones they mentioned aren't. I'm not necessarily against pennies per se either. Sometimes companies are just that cheap I'm not against small companies either. That's the thing. Let's look at the company. It's an $85 million company. People ask if I'm willing to value foreign companies. Some people are like, screw that. Foreign companies are scams. Other people say penny stocks are scams. They're scams in both categories, but there's also really good investment opportunities in all categories. You just gotta be willing to look. I'm not going to look deeper than is necessary, and this isn't looking that interesting to me. It's like this isn't necessarily, I'm not looking to go do a valuation on this. The only thing that I like about this is that at least their operating cash flows are strong. But it's definitely not super appealing to me. But sometimes you gotta look at a cheap stock. Sometimes a penny stock is an opportunity, just like other stuff. So all right, what was next? LLY. Let's take a look at LLY. What's that? What's their shorting at? It's not actually being shorted yet. So this is all just potential. Nobody's there yet. Interesting. What is their valuation looking at? 42 trailing PE, 46, 42, 34, 34, 76, or 27, 77. Well, forward PE, 34. What's the actual growth assumptions underlying that? They're assuming revenue growth of 5.7, 4.8. Relatively high growth there. So what's the assumption that this is a strong short potential? Well, for what reason? I'm just curious. It's like, yeah, it looks like it's probably overvalued, but why this one out of every company in the market? Because I mean, they at least have profits, I mean, 6.1 billion, assuming maybe that the EPS or the EPS growth that they're underlying is maybe based against this number, probably not against that number. 12% per year. I mean, they're sort of assuming probably that the profit could double, relatively speaking, over a 5-year period. That wouldn't get them to still a very great PE ratio per se, especially if interest rates stay adjusted. I've talked about that a lot as well. So that, yeah, I can see lots of reasons for the valuation to correct on this, but is there a specific like catalyst per se? Is there something really bad coming up or something? Weight loss drug type 2 approved by the FDA. Candidate scheme clearance. I mean, it might be a very good short opportunity, but shorting is dangerous. So it's like, don't ever want to necessarily go. I know I don't short stocks. Not that I'm against that necessarily either. If I had the resources to do so, I might be willing to do so, but that's not necessarily something. There's also buying puts against things, but I don't buy puts against stocks either. Maybe whole markets. I buy puts against whole markets, but stocks maybe not so much. But yeah, I don't know. Interesting company. Definitely looks like it's not cheap. That's for sure. I can definitely agree. Cost of raw materials. Yeah. I mean, like I said, I definitely agree it's overvalued. I just don't necessarily see one reason to think that this is the stock out of all the overvalued stocks in the world to short, because I mean, I have a list with plenty of overvalued stocks. Granted, I can be wrong on some of these, but I'd rather, like, I think Tesla is probably a better short still than Eli, but does the balance sheet for AEHL look super bad? It may be targeted as a sympathy play to Eric. NX looks interesting. NX was pretty overvalued when I valued it, but I liked the business. I was kind of wondering if maybe I screwed something up with it, because I definitely came up with a pretty bad valuation for them. But I remember thinking the business looked good. A better short than LLY? Yeah. I think Tesla's much more overvalued than LLY. But I wouldn't necessarily do either one. So, not really a recommendation. But anyway, Interlope Holdings interested. What's the fair value? Well, my fair value for Tesla is about 315. So that's my take. What's Tesla's current PE? 96. 315. I think it should be more than cut in half. So I think it should be trading at a PE of about 40, essentially. That's essentially where I think Tesla should be trading right now, which I think that's pretty damn generous. Like I said, I'm a pretty conservative DCF guy, so and look, I'm giving some pretty bullish assumptions on there. That's not me being negative on the company per se. We want to take a look at what my assumptions are on that. I'm assuming 35% CAGR for the next 5 years in sales growth. I'm assuming they reach 259 to 300 billion sales in 5-year forward period with $37 billion in profit. Gets me into 315. And NRDY too. Helbisio buys a lot of these. Yeah, I mean, NRDY is looking pretty good. I haven't, I lost some money kind of on the SPAC phase, a little bit of that, so I've kind of been a little hesitant to jump back in, and then I reassessed a lot of my assumptions for it a little bit to kind of put it back in place. But NRD definitely looks like it has some potential moving forward, but it's gonna be painful for the next year or two until their profitability is reached. So that's just the trick for that. Helbiz. It's like I've been readjusting it. Where did NRDY end up? Oh, here it is. My current fair value for NRDY is 333, with 509 as the 5-year forward. value. So not really that much, but it's got fair value upside. It's like the interest rates moving up really killed NRDY. That's just kind of the trick with that one. But I mean, as long as they reach profitability and they actually keep up the sales growth that they're expected to do, then they'll be good for them. But yeah, I also readjusted my assumptions though. I've readjusted my assumptions for a lot of valuations as we move through the year, because I've gotten much more pessimistic on certain outcomes. And not to mention then interest rates moved up, which drops valuations. So valuations have moved down on every stock, and then all the other stocks have moved down when the assumptions have moved down as well. Here, I'll go back to it. It's like, I still think they're going to grow, but it's going to take longer for them to get there, which means their present value is lower. Their future value is well intact, but present value is pretty rough. It's like the revenue that I'm expecting them to get this year is not very great. It's growth, but it's not the growth that they're expected to get. They need to keep up strong growth, otherwise they're not worth that much. So. And this number right here is a little bit behind because this is actually has to be readjusted to this. So it's like, this is actually the number. This hasn't been adjusted for the time value of the last 6 months. So it's like you adjust the time value of the last 6 months, and this is actually what it comes out to be. But present value, $3.33. Well, I mean, it's still undervalued. It's just not an amazing valuation right now. And if like I said, things shift around. If these things could shift around a little bit, like the margin that I'm putting in here, like if you go watch my original valuation on it, a lot of the stuff that I did on the revenue projections and the margin assumptions, a lot of that stuff's still useful, but a lot of it was pre-shot in the dark in the first place. So where their margins end up is going to drive this valuation, and like this 4 to 5% I put here is kind of a shot in the dark a little bit. Like everybody's guess is as good as another person's when it kind of comes to NRDY's margin. It could very well be close to double that, honestly, but it could also take a while to get to that, even this level, and stay at like more around 1% for a long time. You know, there's a lot of factors kind of going into that. Like for example, just looking at the earnings, pretty much across the board, I'm assuming that they're going to be unprofitable for 3 years, and the market doesn't like unprofitable business models right now. So that's part of the reason that its valuation has been crunched down so much by the interest rate change, is because all of the valuation for NRDY is in the future. And so because of the fact it's all in the future and the interest rates have gone up, there's not very much in the present value. There's much more in the future value. So future value, I still think it's worth $4.91 to 5 years from now, or actually about $5.09, because again, we have to adjust for the last 6 months. So $5.09 is what I think it's worth 5 years from now. Wait, NRDY and HELB both in these specs, correct? NRDY is a spec. HELB is, I don't know. That was the other one he was bringing up. Maybe it is. Looks like it was. But this is what it looks like. It is. There's too much insider sells in the energy sector. You got some overvalue one. I have some overvalued energy valuations, but honestly, I think I need to revisit them. I'm not necessarily super confident of them, so I don't necessarily want to get into them too much. The only one that I have that is current that I feel reasonably confident in is my SHEL valuation, I think. Let me see, and it's still pretty. I think SHEL's pretty overvalued. Most of oil is pretty overvalued. Although it kind of depends on how you look at it. I did own SHEL for a while, and then I sold out of it. And it's possible I could do probably with an upgrading of this one. This one is maybe a little bit behind. 29 is on it. Again, we need to adjust for it. So 31.14 is where I think they're worth. I think they're worth about half
where they're currently at. Then if you adjust for the next 5 years, then they're worth 52.16 5 years out. They're currently trading at 61. This is under certain oil assumptions though, so that's the other thing you have to keep in mind, is that I built my model for SHEL based off of these oil prices, an expected value of $75 a barrel. So I'm assuming 5 years from now, oil is going to be $75 a barrel, and that's how I got this valuation. So obviously, if you're aware where oil is right now, then you might be thinking that this part of the valuation makes it look a lot better, and then you'll see that the present value becomes more like $65, or actually if you adjust for the time, it becomes $68, $69. So, and I mean, this assumption also includes the margin assumption. So maybe if you cut kind of between the two or something, assume maybe oil is $100 a share 4.5 years from now, then it's still worth $40 today, $66 5 years from now. So, you know, it kind of depends on your views of oil, what you think about oil stocks. That's kind of the thing you have to understand, like when it comes to DCF, is that oil is part of the equation when you are talking about an oil company DCF. So that's worth noting, is that I sold out of my position in SHEL several months ago. I was a little bit early on some of the peak levels, but you know, either way, we made good profits on SHEL. But my valuation said that basically on an assumption that oil 5 years from now is $75 a barrel, it's overpriced. So that's that. Let's see. Rig. Is this exactly what I think it is? It's just a tanker or something? What is it? Yeah. Offshore contract oil drill services for oil and gas wells worldwide. Yeah. I'm not super interested in the space, honestly, until oil prices have some sort of crash back down, which granted could be a while, but the point is it's too late. The boat's too late on basically the sector. There's probably a gem somewhere in there or whatever, but it's going to be fighting against the current, even if it means just declining less than the other guys or something. I'd much rather look at some other spaces. Some of the other mining sectors, like some of the metals, I think have lots of ground to catch back up. I'm pretty bullish on copper. Too late on CVX, probably too late on a lot of the oils. That's just kind of the game. I was just looking at Helbiz, and honestly, I don't know. I didn't say my thoughts out loud, but it didn't necessarily look super appealing. Interurban transportation company provides micromobility services in Italy, United States. So, yeah. E-scooters, e-bikes, e-mopeds, miniature Uber, just off the insider buys. Oh man, yeah. So anyway, those other companies that were on my watch list that I was more interested in maybe doing in the near future. We got Sturm Ruger, 1.1 billion. Liberty's of interest. Lazy. OVV, which ones were those? So we had some oil ones in here as well, like EQX. Wasn't that an oil company? This one was oh no, this was the gold company. Which one was the oil company? Is it OVV? Maybe it was OVV. There were some other ones that did show up in the watch list, but even so, I was kind of like thinking about it more, and I was just like, do I really want to buy into such a bullish point? Oh, this is natural gas. This was a lot of natural gas. It wasn't oil, it was natural gas. Close enough. Don't necessarily want to buy into the top of cycle. Anyway, I'm gonna say that's probably gonna be it for today. Like I said, I am considering doing evaluation of Ruger or Liberty perhaps in the near future. Those are the ones I'm kind of considering for the near future. You guys gave me lots of suggestions, but none of them were honestly too enticing. I know I didn't look at all of the ones that were mentioned, but kind of they come at kind of rapid fire. Lazy days. Operates recreational vehicle dealerships under Lazy Days name in the United States. Provides RV repair services, financing, insurance products. I have an IPO for tomorrow. You should at least, you know, PEV. Maybe. All right. I'm going to call it there. Like I said, not sure which one we're doing. Walking in front of the camera. Not sure which one we're going to be doing next. I do think the next stream is probably going to be on Monday. My streams are going to be kind of a little haphazard for the next couple of months because I am doing some full-time work for the summer. If you haven't already liked the stream, it'd be very appreciated if you would. If you are watching and you aren't already subscribed, it'd also be appreciated if you subscribe. And it's the pinned comment in the chat as well as in the description below. Join the Discord. I know one or two of you already did during the stream, but joining the Discord, you can kind of keep up with these conversations. You can give me more of your suggestions and also keep throwing more tickers at me, possibly before I make my final decision in the next day or two, which company I'll do. But either way, probably looking to do one of these companies. Like I said, thinking RGR probably. That's probably the one I'm going to go for. Partially because I've just been wanting to pair it up against Smith & Wesson as well as the retailers for the gun manufacturers that we've talked about and kind of have them as a small comparable group. All right. See you all later.